Good afternoon and welcome to the first of our client webinars for 2024 from the very impressive new media suite here at James Hambro & Partners. Not for the first time, we find ourselves presenting against a backdrop of political turmoil and uncertainty. The situation in the Middle East is precarious. The war in Ukraine, despite being old news, is likely to be protracted. And we have upcoming elections, both here in the UK and in the US. And yet on the economic front, there's been success in bringing down inflation, both sides of the pond, and markets have rallied strongly since our last webinar in October. So to make sense of the markets and to update you on their new Harrier funds, I'd like to welcome what I hope are now the familiar faces of James Horniman and Billy Hughes. Gentlemen, over to you.
Thank you, thank you very much, Dominique. Much appreciated, and thanks for taking the time to come up to London. So today we thought it would be a good idea to have a recap about the Harrier MPS range. We are now about 6 months into the start of the new investment approach, and we're delighted with the performance so far. Year to date, we are, depending on risk framework, at around 3 to 5%. And since October last year, when we placed the rebalance into the new Harrier MPS range, we're about 8% to 10% up. We've obviously had a fair wind from markets, but we're delighted with the start so far.
Absolutely.
We will talk briefly about our investment approach and our exposure to direct companies. We'll then go on to talk about the market review of the year to date. Obviously, equity markets have climbed higher, but with that, we are climbing the ever-present wall of worry. We will then talk about what we have been doing as a company and an investment team to navigate those conditions. And then we'll spend a bit more time on where you are as the client actually invested. So the types of stocks that you have exposure to now in the Harrier MPS range. So James will talk through Intuitive Surgical, which is a US-based medical devices company, and I will talk through Next PLC, which is the very well-known and recognisable retail company that you will all know from the high streets. We'll then go on to talk about the longer-term outlook and expected returns from here. And we've got a few questions and answers that have arisen since our rebalance into the new proposition, and we can cover off those and a bit of housekeeping there as well. So as a recap, because I know we discussed this at the last webinar, the Harrier MPS essentially allows Dominique and clients to access our best ideas. So through the launch of a global equities fund, a fixed income fund, and a diversified strategies or alternatives fund, we can now put together models that we feel really give our clients the best of our ability to pick investments and to navigate tricky conditions and hopefully reach and achieve the financial objectives that clients have. So what does that give our clients? It gives an unconstrained investment universe. So that's access to direct bonds, direct equities, and some funds that perhaps would not be available to invest on platform. So we really have an unconstrained universe of where we can access ideas. It also gives us our ability to pick 30 to 40 of the best companies across the globe and allow those companies to grow and hopefully, importantly, meet and beat long-term objectives and grow in real terms. So grow, taking into account inflation, people's wealth, and that I think is the most important thing that, or the most important evolution from the Harrier MPS to where we were before. So with that, and also the exposure to bonds, cash, diversified strategies, we really are happy with how our exposures are now. And one question that came up that we might just cover off here is, how is the new proposition more cost effective? Well, the new proposition is more cost effective because within the bonds and equity fund, we are now accessing direct bonds, so UK gilts, US Treasuries, and direct equities, so company exposures like Microsoft, like Intuitive Surgical, like Next that we spoke about earlier. And access to these direct companies removes a layering of fees by not investing or deploying capital to third-party fund managers, which is how we used to invest based on the legacy MPS that we had. So not only does this allow us to focus returns, we have the ability to put our best ideas into the models, but it also reduces a layering of costs, which is beneficial to you, the end client.
And I think we've been seeing that to try and put a number behind that, it's roughly about 0.2 per annum that the funds are, the new approach is cheaper than the previous way of working.
Yeah, absolutely. That's about right, give or take. Our investment strategy has not changed. We just have a better way of accessing exactly what we want to, and it's more cost effective. So it's a win-win scenario in both instances.
And I think I was also going to stress, I've been talking about with clients, is the fact that it's new to us at Kingswood,
yeah,
and the old Regency way of doing things, but this is what you guys do all the time. I think that's worth stressing as well.
Yeah, absolutely. That's exactly right. So since our inception in 2010, we have always looked at and invested in global direct equities. And now we have a vehicle and a platform that allows us to put that into our models, which is absolutely where we want to be. We are future-proofing, hopefully, our investment process going forward. So we mentioned we're going to talk to a couple of companies and bring those to life, but I might just spend a couple of minutes talking about the types of companies that satisfy our investment approach. So we are essentially looking for above average companies, regardless of where they're domiciled. So that might be in the US, in the UK, in Asia, in Europe. We're looking for above average companies, and we give them the time to grow their earnings over a longer period of time. And we discussed this at the last webinar, but with earnings growth over a longer period of time, so a 5-year plus growth in earnings, you get a good, there's a good chance that you will see material change in shareholder return. So if earnings grow from a company, so when I say earnings, I mean the sales that the company gets from selling its produce, from selling its services, etc. When you get that earnings growth, you then get share price action, and that then translates into good performance for clients. So what type of characteristics are we looking for in companies that we are trying to put into these models? So we are very much aware that culture is incredibly important for getting the right type of longer term approach. So culture, as is in our firm, as is in your firm, Dominique, is all important. And culture revolves around people. So if we can identify the right management teams and the right management teams that put in place the correct culture, then that's a good starting point for when we are looking at company investments. We then want to look at the business model and the quality of that business model. Essentially, we want to identify a company that has a competitive advantage that facilitates that longer term growth in earnings. So a competitive advantage could be location of stores, it could be patents that the company has with regulators, it could be the quality of their brand or their brand power, it could be the scale, it could be the network effect. But for instance, to give you an example, Microsoft obviously have, if you've ever used a computer, you will have used Word, Excel, PowerPoint, and lots of other suites of products. Now, people use those on a daily basis, and to switch to another provider, you'd need to train up on new systems, and you'd also need to withstand the disruption that would cause in your business. So actually, the cost of switching from Microsoft products is incredibly high, which allows Microsoft to have a competitive advantage and, in times of inflationary pressures, push up prices. Now, we, the consumer, need to pay those prices as it's a relatively low cost aspects of doing your wider business. So we are very much beholden to using Microsoft's suite of products, And that to us is a competitive advantage that we see lasting for a longer period of time and helps give us some certainty over the longevity of the earnings that we spoke about earlier. So we are also looking for stuff like recurring or predictable sales, Microsoft's 365 suite, low cost and mission critical products. So for instance, it could be Amphenol, which is a US company that we invest in. It is involved in producing sensors and connectors, which doesn't sound very glamorous, but the types of products that you would find in your car, in your phone, they essentially allow the phone to work, and it translates an electric signal into something that can be used and be useful and give you some sort of output. So they're very low cost relative to the cost of an iPhone, but the iPhone doesn't work without Amphenol's products. And it's that type of product or service that we are looking to invest in. Low capital intensity essentially means we don't want lots and lots and lots of assets at fixed cost on the balance sheet. We want low capital assets or low capital balance sheet that will allow companies in good times to ramp up production at relatively low marginal cost, but in bad times to be able to manage the downturn and be able to come out the other side of any recessionary pressures in a much better situation. And that is a good segue into limited financial leverage. So balance sheet strength, not too much debt. If there is debt on the balance sheet, we need to understand why there is debt, and it may be because they've just undertaken an acquisition that may be good, but it's all about understanding what's going on, but usually good balance sheet strength. Now, all of this, when we find those types of companies, we put them together in a model. We then hope that we benefit from the compounding effects that are termed by Albert Einstein as the eighth wonder of the world. So compounding over a longer period of time with good returns should see pretty good chance of achieving your financial objectives.
Excellent. And James, when Billy's saying there that you're looking for these common characteristics, just very briefly, how do you look for those? What contact do you have with the companies that you're researching?
Yeah, I think it's a very good question because, as Steve Jobs said, it's about being able to say no to an awful lot of companies because there are clearly quite a lot of companies out there. And the hopper that we use does get filled up with a vast amount of information. And our job really is to decant that down into a portfolio of 30 or 40 shares, be really rigorous about what Billy has just described. And also, more importantly, arguably, is to carry on checking that we've got the right companies and kick the tires, as we say, all the time to make sure that those 30 or 40 shares are the best in class. And we are willing and able to kick them out as soon as we think that there's been a change. And there will be a bench where we've got other companies ready and waiting to join the portfolio. And if a stock on the portfolio underperforms or changes in any way, we will replace it. It's a very, very important question.
And I would just add to that, actually, we spend a lot of time researching. We are only looking for 30 or 40 companies. We have conviction in these companies, and to gain conviction, we have a 31 strong investment team that speaks and debates about these companies. But we also go and meet management teams. We have management teams that come into our office. We are of a size now where they take note of what we are doing. And we also have a very experienced and good broker network where we bounce ideas off. So it's very much trying to get as much information as possible, distilling that in a concise way, and then making the right decisions on behalf of clients.
Excellent. Sounds very robust.
And maybe just to add to that, James Hamber & Partners was established with Andy Steele, who's our chief executive, and he runs the company, and the fund managers run the client service element and the portfolio. So very, very significant distinction between the two, basically meaning that we can get on with our jobs of running money and talking to clients, and he runs the company.
So now on to a review of where we currently stand in markets. And after a couple of painful years, it's nice to see some positive returns. And although markets are nudging up towards all-time highs, we think you can paint a positive picture about future returns, and we'll come on to talk about that at the end. But we are very much aware that interest rates have climbed higher. So UK interest rates at about 5.25% and US interest rates a little bit higher than that. Now, as you can see here in this chart, this charts the level of interest rates and actually points to areas of financial stress. So going back to 1985 through to 2025, the most recent one being the 2018 global sell-off, the last time interest rates were climbing higher. And we've placed a question mark over the current high level of interest rates because the jury is out as to the direction of travel for economic growth. But we are aware that higher interest rates to control inflation that we have seen peak and come down. But higher interest rates do usually stymie demand and cause some sort of issue in the economic environment. But so that's where the climbing the wall of worry phrase comes from, because as markets climb higher, you're always thinking, okay, well, what's the right time to divest and bank some profits? Well, we've got a very good slide showing that there's never a good time to do that, and you should always remain fully invested unless your financial objectives or your circumstances change. But let's just analyze why markets have climbed higher. So in the US, economic growth has been incredibly robust. So the US economy, which is the largest economy in the world, and for context, is where we have a lot of our equity exposure. So very important to us when we are looking at returns and future returns. The US economy is growing incredibly strongly, despite or in the face of higher interest rates. Now, the IMF is forecasting the US to grow at 2.7% this year, which is almost twice as much as any other G7 country or other rich world country, which is incredible given the size of the US. So let's find out why the US is doing so well when one would expect interest rates to curtail that growth. So on the one side, you do have higher interest rates, but on the other side, you have got a huge amount of money being ploughed into the US economy through government spending, so through fiscal stimulus. Now, this amount of money goes to help out with infrastructure spend. It goes out for supporting the economy and the public through the pandemic, but it also goes through to some structural trends that we'll come on to talk about later, like energy security and reshoring and making life a little bit better for Joe Public rather than having supply chains all over the world. We'll come on to talk about those opportunities, but to put that figure into context, the US is spending $2 trillion more per year than they did pre-pandemic. So that is a lot of money that is going into the system. And we all know that liquidity and cash is very important for the correct functioning of markets. And if you think that labor is pretty strong in the US, economic growth is strong, the consumer is pretty strong, and corporates, so company growth has also been pretty strong, then it would take a brave person to bet against the US. We also know that now, despite wars and geopolitical tensions rising, energy, so the price of oil, is less relevant to the US because it is self-sufficient in oil. It almost produces just as much as it consumes, and so is more immune to oil price shocks than it certainly was in the 1970s. It may astound you to note that the US is actually the single largest country producer of oil in the world, which, you know, not being part of OPEC plus is quite surprising. So we're aware that interest rates have climbed higher. We're aware that higher interest rates usually stymie demand, but so far the US economy has shrugged that off, but something definitely to be aware of.
I was just going to ask Billy, I think to what extent that we see the politics and economics in conflict again, in that despite the anti-immigrant rhetoric from Mr. Trump and others in the US, arguably it is the wide-scale immigration in the last couple of years that has led to a lot of the economic growth in the UK without it being inflationary.
Yeah, absolutely. If it wasn't for immigration, then the US would be fighting a lot higher inflation, because wage prices, which is one of the more serious causes of and more sticky causes of inflation, would be considerably higher. And I actually saw a survey saying that that people were more in favour of immigration now than they once were in the US. So potentially the sundial of consumer opinion it might be changing there as well.
I mean, it is free market economics, isn't it?
Yeah.
Where people and capital will flow to where it needs to go. So you could argue that it's quite hard to stop that.
Yeah, absolutely. And the US has grand plans to reshore and generate more self-sufficiency in supply chains. I think, you know, a lot of economies were burned by supply side shocks and China's zero COVID policy, and China was obviously a huge producer of the world's goods. But very recently, the US government has been giving lots and lots of tax incentives to bring production back to the US. TSMC, which is a semiconductor company, is launching or opening a factory or fabrication in Arizona in the US, and that's one of many types of productions that are coming back on shores, which should benefit the man or woman on the street in the US. Now, not to sort of gloss over the UK and Europe, but in terms of concentration and market returns in 2023, we saw, and I'm sure you would have read this in the financial press, we saw a great deal of performance come from only 7 companies, and those 7 companies I'm sure you'll all know of. So Tesla, Apple, Meta, the owner of Facebook, Amazon, Microsoft, and Apple. I think I might have repeated Apple twice there. So the returns from the world markets last year came in the form essentially of 7 pretty spectacular companies. So if world markets returned 14.7% in 2023, 9.4% of that came from these 7 companies, and the rest of the market returned only 5.3%. And we'll come on to talk about why we think that's an opportunity actually rather than a risk, as many people are looking at as things stand. But one incredible stat is that Meta, Tesla, Nvidia, Amazon, Alphabet, Microsoft, and Apple are now of market cap, so the amount of money that their companies are worth in aggregate, rival that in total of Canada, France, China, UK, and the Japanese equity market, which just shows you how powerful these companies are.
If I was watching this seminar, the question I would ask is, can that continue? Because clearly I was around during the 2000 bubble where technology companies just got absurdly overvalued. And I think there is an element of that in some of certainly the Nvidias of this world. But when you look at their earnings profile, the upgrades to their earnings have outstripped their increase in share prices. So arguably, stocks like Nvidia are actually cheaper than they were 18 months ago, even though they've doubled in the last 6 months. So there is clearly a paradigm shift of some sort going on, but I wouldn't be surprised if you saw a little bit through this quarter, in fact, where you've got some pretty serious upgrades needed to maintain those share prices. What might happen is a slight slowing down of the progress of those stocks, hopefully, and the rest of the market catching up a bit. So perhaps a broadening of the returns across the North American space. And that would suit us down to the ground, because we prefer picks and shovels type stocks, as Billy's alluded to. So stocks which are going to benefit from AI rather than necessarily creating it. So Microsoft and Amazon, for example, with their storage business, or stocks which we're looking at the moment who could call down service, for example. Those things like that, which hopefully will be the next stage of our development in terms of stocks.
And trading at cheaper valuations.
Yes.
And so actually, to James's point, we've actually seen Apple and Tesla since the start of the year, their share price performance has not been as good as it was last year. And we've seen that broadening out of performance across the rest of the market. And we think that that's set to continue. And I might just cover off the recent navigation and changes that we've made in the model. So we have held Microsoft, Alphabet, TSMC last year, which has been very good for us, giving us that tech exposure. In February, we purchased Amazon, mainly because we think that the valuation is quite attractive relative to its longer term average. So it's cheaper relative to where it's been in the past. And we think it's got a pretty good set of opportunities for revenue growth going forward. And we also have sold TSMC, which is a Taiwanese semiconductor company, on concerns on geopolitics. So we made good money in that, and we will move on from that. And elsewhere, we've been adding to companies that have performed less well, the likes of Texas Instruments, United Health, Sony, Union Pacific, Louis Vuitton, and Alphabet. So we are very active in that respect, but always with the longer term. What are the earnings growth looking like? What are the current valuations looking like? And how can we best navigate tricky conditions as we currently see them?
And that goes back to what James was saying earlier with, keeping an eye on the stocks once they're in the portfolio. And if you think they've made, the earnings growth that all they're going to make, and that is going to be downhill from here, then you're happy to cash in the chips, take the growth, and find something else for the future.
Yeah, absolutely. We have to be on top of it. We don't own Meta or Facebook, but it had slightly disappointing results overnight and was off or is likely to open up in the US weekly. So we need to, or weaker. So we need to be on top of these things because current environment, things can change quickly. But the most important thing, next slide, please, is as ever, and this is the only slide in the deck that we use in good times and bad times. So this slide illustrates the challenges of market timing and why, on average, it's best just to remain fully invested. So it shows here the returns of the world markets from 1999 to the end of 2023. Being fully invested over that period would have returned you 260%, but missing the 30 best days, so the best days of returns, that return drops from 260% to -2%. So that is incredibly stark and incredibly important to remember, because it can be very psychological and emotional in investing. You need to be able to, as long as your time horizon is long term, and as long as you're alongside your advisor and with Dominique's advice to your conditions and your circumstances haven't changed, it is always best to be fully invested in the bad moments and also in the good moments. So when markets are nudging all-time highs, I would still recommend being fully invested.
Our clients are quite familiar with these sorts of slides, Billy, as you can imagine.
Absolutely.
And the good old phrase, time in the markets rather than timing the markets, because quite frankly, you've got to be lucky twice.
Absolutely.
On the way out and on the way back in again on the timing front. So yes, they're very familiar with us reminding them of this on a regular basis, but importantly sitting beside them during difficult times, and helping them override. As you said, it's an emotional instinct. Things are going down, you want to get out. It's overriding that and keeping focused on the long-term goals. So I'm very pleased we're all aligned there.
Absolutely. So now we'd like to talk and bring to life some direct company investments, starting with Intuitive Surgical.
Absolutely. I'll give you a second or two to take in the slide. But what we've got here is a company which basically makes one thing, which is that machine you're looking at in the photograph on the slide. And it's known as the Da Vinci machine. And this is a robotic surgery device. And as you can see there, the surgeon, rather than doing butchery, is actually playing a video game effectively and controlling the thing in the middle, which is effectively loads of robotic arms, which conducts the surgery on his behalf. So why do we buy this particular share on your behalf? Well, I think the way we're going to make money is that, as I said, it's transforming surgery from a fairly primitive pursuit into something which is much more modern and much more technically advanced. The company itself has been doing it for far longer than anybody else. It's been doing it for at least 20 years. So there's a first mover advantage in terms of the technology they've got. Others are coming up on the rails, but as Billy was alluding to earlier, these surgeons have been trained on this machine for quite a long period of time. And what tends to happen is that once they're trained up, they don't go anywhere else because they know how it works, they like it, they got used to it. So the efficiency of the machine is high. The surgeons can do procedures at a multiple relative to the old way of operating. So they can do 5 or 6 procedures a day. A lot of the incisions are microscopic, and therefore the patients can have much better outcomes, much faster outcomes, and they can leave within sometimes days of big procedures. So the moats around the business are the fact that the surgeons are trained, the software updates come through, so there's recurring revenue coming through. The machines are extremely expensive, as you probably imagine. That's obviously the downside, but they're being rolled out across the world. So for us, the story is exceptionally powerful. It's taking technology, but actually putting it into a human form. It's using some forms of AI as well, which is quite interesting. If you look at their website, they'll explain exactly what I mean by that. So as far as we're concerned, it's a rollout story across the entire planet of basically doing something in a better way. And everybody benefits from it. And the shares have been exceptionally strong, and we think that that will continue over the next few years. And I think it's probably one of our best examples of the added value that we can find out there. And hopefully it'll continue. Absolutely.
And I think the reason that we've provided an example like Intuitive Surgical, and if we go on to the next slide, is to show you the breadth of the type of investments that we are looking at. So Next PLC, you will likely all know as the bricks and mortar retailer, which from a stock market perspective was a darling up until 2017, when we all know that Amazon and Jeff Bezos entered the fray and started to take over share of our wallet and our spend, and the demise and reduction in footfall of the high street. Now, Next, and this goes back to what we were talking about right at the start, has a management team that has been in place for a long period of time and is very proactive and very able, and saw the structural change that was ongoing, and actually changed its business model or evolved its business model to adapt to changing consumer trends and changing ways of operating. So what did it do next? So it has a huge presence on the high street. It rationalized its store square footage, so whether that's reducing its square footage or moving to out of town areas or industrial estates to get better footfall, get better move away from the high street. It also started to rent out areas of its stores to places like Costa, etc., to add in some additional revenue, but also to increase or improve the experience that consumers get. What it also did was put a lot of money and effort into an online presence. So what Next now has is what's called an omni-channel presence, which is bricks and mortar stores, but also an online platform where Next is not only selling Next goods, so clothes, it is also selling its wants competitors, so the likes of Nike, Adidas, etc., on its platform. And because of its distribution network, so its stores, etc., and also its delivery that it's worked hard to improve, Next is now a place to go, whether you're there physically in stores or whether you're online, to go and buy products. Now, as the decline in retail and decline in high street was exacerbated by less people going there and less people shopping in person, lots of stores and lots of brands have struggled. And Next, with its balance sheet strength, has made the best of that, taking over the likes of Made.com, Joules, etc., etc. And what that has allowed next to do is buy these companies at pretty fair valuations, but also start to build scale. So where does Next stand now? It takes less inventory risk because it sells online and it sells other providers online. It's expanding overseas, and its online presence is now 70% of profits, where pre-pandemic it was about 50%. So this is a great example of a company that is evolving to adapt to changing consumer trends, and again has been one of our strong performers, and one that perhaps you wouldn't necessarily expect from a UK retail company like Next.
I think they're both really great examples, Billy, of one, a company, to be honest, I'd never heard of previously, and yet you, James, when you explain this, the sort of background story, makes perfect sense as to why that is a high earning company both now and has got to be going into the future with aging world populations, etc. And then, as you said, perhaps a more mundane stock that we think of it as Next, and yet probably like many busy working parents has been the saviour with its internet presence, where you can book till 11 o'clock at night when your child has just told you World Book Day is in 2 days and they want to be Harry Potter, and something arrives in time. And as you said, compared to something like Debenhams, where clearly the management team were not agile and didn't foresee things, and therefore didn't survive, and Next have gone from strength to strength. So
I would add that Next has got the best chief executive in the UK as well. Lord Wolfson, I think, is known to be that individual. And I think that does highlight that we do look at management teams and that qualitative judgment on individuals rather than just the numbers and the facts around a company. It's the feeling you get when you meet him that he is totally and utterly in control of that business. And actually one of the biggest risks to Next would be for him to leave. And that's something we're monitoring all the time, and frankly asking him what he's doing and whether he wants to become a politician or not or anything like that. It's all part of the process.
So hopefully that has brought to life the types of companies that you own within the models. We will now talk a bit about a market update and where we see things going forward, and paint a picture, quite a positive picture about hopefully some economic growth, sustainable economic growth over the course of the next decade. Before we start to talk about that, I'd like to quickly just highlight a couple of things that we're looking at the moment, and I'm sure you're reading in the financial press or the Sunday papers. Inflation has obviously peaked. It peaked some time ago, but the pathway down to most central banks' target of 2% has been a bit slower than expected, and more recently, over the course of the last couple of months, we have seen some increases in the inflation figures, the 3-month figures, but the longer term direction of travel should be towards 2%, and that is likely to be because interest rates are remaining where they currently stand. So one risk is if inflation picks up, but we're not overly concerned about that, but something to consider. Where we think we will get to is inflation gliding down and interest rates starting to be cut by central banks, but probably interest rates that will be higher than they currently, interest rates that will be higher for longer. So the market at the turn of the year, so market expectations for interest rates and their rate of cutting at the beginning of the year was for 6 rate cuts in 2024. Because of stronger economic data and stronger inflation data, that is now below 2. So we have seen a material change in the expectations for future rate cuts. We don't want to predict, making predictions on something that is so difficult to sort of get ahead of, I think would lead us down a difficult path. But it is likely that at some point this year interest rates do get cut in the US and the UK, but that will only happen if we see continued evidence that the inflation battle has been won. This slide here shows the growth in shows economic growth in the US So we can see that economic growth has continued to nudge higher, and it references that 2.7% figure I referenced earlier on in the webinar. But it's incredible resilience from the world's biggest economy. This is US economic growth. It's very important that the US grows strongly, because that sets the tone for the rest of the world. So usually when economic growth is strong, company performance or company earnings follow suit, and that should lead to good solid returns.
I would add also that one of the reasons why markets have done what they've done is because of that return of inflation. People think that inflation is a dirty word, but actually a little bit of inflation in an economy or in the world is actually quite a good thing. Flux for price increases, etc. But the thing, and one of the reasons why the market has done what it's done, is because when inflation is around, you want to own real assets. You want to own assets which have the ability to price in inflation, and that is equities. Now, things like gold has done quite well as well, but in the long term, if inflation is part of the furniture, okay, it's under control, but still around, then owning bonds and cash in those environments is actually not as beneficial as owning equities. So I would put some of the rush back into equities back through 2023, particularly down to that feeling of inflation's here and it's under control, as Billy was saying. And now we're in a position, I think, where equities can continue to do well, because that's the asset class of choice.
Next slide, please. So this slide shows valuations across the world. So valuations is essentially whether a market or index is expensive or cheap, and that is demonstrated on this table or chart by the y-axis. So the higher you are up on that chart, the more expensive. The lower you are, the cheaper it is. So that blue line is the NASDAQ 100, which is a proxy for the US tech companies in the US. And you can see there that the blue solid line is materially higher than its long-term average, which is the dotted line. So quite expensive tech valuations, but that's, we all know that because of the performance we've seen from some of these spectacular companies like Tesla, like Apple, etc., etc. The red line is the world market. So that's every listed company in the world. And you can see there that it's just about above the long-term averages. So the opportunity here is the grey line, which is the equal weighted index, the equal weighted world index. So that solid grey line is below its long-term average, which actually means there are some really good companies with valuation attractiveness, so attractive valuations that are less lofty than the big tech companies that we know. And that gives us as investors the ability to find these companies. And hopefully, if we can get the earnings right and we can get the management teams correct, then these companies should have a lot of upside in their ability to generate longer term value for shareholders. So in summary, yes, there are some expensive and stretched valuations in tech, in the NASDAQ, in that blue line, but the opportunity set is the rest of the market is on an equal weighted basis trading below its long-term average. So that's important to note when we are looking at constructing portfolios. So we will end on why we think that the longer term presents good opportunities. There are lots of strong structural drivers of growth. So when we say structural drivers of growth, what we mean is there are changes afoot that will allow companies to benefit from natural tailwinds of whether it's aging demographics or improvements in healthcare, whether it's reshoring, which we spoke about earlier on, whether it's the energy transition and the energy security, whether it's the infrastructure investment that's coming from fiscal spend. Remember that $2 trillion figure we referenced in the US? There is a less amount, but a similar effort going on through the European efforts. There is lots of money that is going to fund these changes. And if we can pick the right companies then that will benefit us and benefit performance for our underlying clients. So there are lots of reasons to be excited about the future, because as a reminder, from 2010 to 2020, you saw easy monetary policy, so lower and lower and lower interest rates. That didn't help economic growth. That did help asset prices. This time round, we're seeing lots and lots of fiscal spend, so government spend on actual real things like infrastructure. And that should benefit not only the man or woman on the street, but also companies through their earnings trajectories and their ability to generate future returns. And that should translate to pretty solid economic growth over the next decade.
When I look at this particular chart, I think it emphasizes the cyclical and the circular elements of our process. But also, if we are trying to get people to sleep well at night by investing their money in a particular way, then I think this does actually show you that you can understand exactly why we're buying individual companies, understanding what they do and why we're doing it. So hopefully people can worry about other things and not investment.
So just before we end today's webinar, we do have a couple of questions that Dominique has kindly forwarded to us ahead of time. The first one was, how do we protect capital values in the case of war in the Middle East? And also an extension to that, what impact do elections have, especially the US elections, on market values? So it's very difficult to predict geopolitics and elections, and we as investment managers, as stewards of client capital, need to really look at all aspects of what's going on: elections and geopolitics, valuations, company dynamics, bond yields, etc., etc. But we really need to play the percentages. And by that, I mean, we need to have a portfolio that should respond well in either outcome, when it's such a binary thing like a war, or such an unpredictable thing like a war, such a binary thing like an election. So it's not putting all of our investments in what that will do well if one outcome is reached. It's having protection and having a real keen eye on capital preservation in these sort of binary outcomes. We know that politics over the longer term doesn't really have a massive impact on the direction of travel for markets, so we are comforted by that. But it's definitely something that we consider, and we spend a lot of time on to make sure our portfolios are constructed in the right way to play the percentages, to make sure we're not exposed if we get the prediction incorrect.
So it really just goes back to what we were talking about on the earlier slides of keeping your nerve and staying in the market regardless. And I think for clients who are going to have, if we see interest rates start to fall, they might have had money on cash that then comes to the end of a fixed rate, and they're worrying about whether to add it back into portfolios and market exposure. And again, can I time that? And I think the answer really is we can't time that. These things are going to happen or not happen, and with a long-term view, it's best to get in and stay in.
Yeah, and maybe just to focus upon that first point, one of the best ways of answering the question as to what do we do if there's an event we don't know about which suddenly happens, whether that's a war. Well, I would go back to actually what we did at the start of the pandemic, which one of the biggest friends that we've got is our speed and the ability to be nimble and make decisions very, very quickly. We're a relatively small company, relative certainly to some of our competitors. And when we make decisions, we do it very swiftly. And during the pandemic, we increased liquidity very quickly in the first week of the pandemic, in fact, and then sat down and said, how do we redeploy that? And that was not a panic. It was get that cash there, think about what we're going to do with it. And then we did invest into the winners through the pandemic, so the Amazons of this world, and that's where it went. So I would answer that first part of the question by saying we're nimble enough to react to whatever happens.
Okay, great. Because it's an important point, because I know that this consumes a lot of press time and inches, and it can become quite worrying. If you look at the Brexit referendum, which was a shock, going into the odds were what transpired was not what the odds had predicted, and also Trump's election. Actually, markets responded pretty quickly and pretty well to both of those events, which is not what one would expect. So even if you do feel like you are on the right side of it and you do get it right, the market doesn't always turn around and reward you for that. So you need to be a little bit, we feel that playing the percentages is always the best way to go about it.
Right. The
final question we have is, how quickly do we anticipate the first interest rate cut? Now, we are unlikely to get this right. I would split that into two answers. In the US, I think it looks likely that inflation, because of the strong economic growth, inflation will be a bit more stickier than we are witnessing in the UK. So I would imagine that the US is more difficult to predict, but I certainly feel like the direction of travel is for interest rates to start to come down, but only when the Federal Reserve, the central bank, is comfortable that they have completely stamped out inflation and it gets to their 2% target. As I mentioned earlier, the market is expecting about 2 rate cuts this year, or just below 2 rate cuts. I wouldn't be surprised if we only see 1 rate cut, if any.
So we won't hold you to the exact month, but no, perhaps we'll say before our next autumn webinar.
Yeah, potentially. And in the UK, inflation looks to be coming down more smoothly, and we are less. Our economic growth is less robust, and we've just come out of a technical recession, which is good, but it's not, it's not 2.7%, which is what it is in the US. So I think there's more leverage for the Bank of England and Andrew Bailey to lower rates quicker. So make of that what you will.
Okay, that's great. Well, gentlemen, thank you very much. As always, we value your opinion, and I think today the update on the Harrier funds and a little taster of some of the individual shares in there was particularly useful. So I'll thank you on behalf of all the clients for that, and we look forward to seeing everyone again, as I said, usually around October, so in the autumn later this year.